Seen the Fed go crazy, right? Just trillions of dollars being printed. Look at the last meeting. Every single committee member said they expect the Fed funds rate to stay near zero until 2022. They're bailing out even nonprofits, right, in their loan eligibility program. So it's buying 95% of all eligible loans made by banks for nonprofits. They're just backstopping a whole bunch of stuff, including the government. But you're looking at the Fed where people say, well, the Fed is running out of tools. And they don't really ever run out of tools. I think we actually know that. But there's one tool that they use that it's probably going to be announced over the next couple of months. I've seen a story or two. I've been doing a lot of research on this. And if they do announce this, you're going to see small caps in particular, I think, really take off here. Now, this obscure Fed tool is called yield curve control. It's YCC for short. So if you never heard of it, don't worry about it. I'm not surprised because it's only happened one time. The Fed only implemented this policy one time in the history of America. That was in 1942, 80 years ago. Set off one of the biggest bull markets of that era. So YCC, when that policy was put in place, look at S&P 500 went from its lowest point in a decade to highs not seen before the Great Depression. Right? That's how big this was. So when you look at YCC, it's like quantitative easing, but with a little bit of a twist, right? So QE is when the Fed agrees to buy a set amount of government bonds. You guys know this as printing money. With YCC, the Fed doesn't agree to buy a set number of bonds. Instead, it sets a target price and says it's going to buy any amount of bonds. The market would sell at that price, which could be limitless. And when you use the word limitless with someone that has a printing press that can print a limited amount of money, it's pretty crazy, right? For me, when I believed that this market was going to come down tremendously because of COVID, it was a little bit late. We participated in the way up. But for me, it was the numbers, like Disney reporting numbers, the stock is up. I could tell you if there's no COVID, Disney's going to be a $300-$400 stock if it's at $125, $130 now. I mean, revenue's down 40%. Every single segment got killed. They took write-downs. The only thing that's doing that they say, right, they pointed to the amount of subscribers they have on their platform, and everybody cheers that. But the operating loss for that segment, direct to consumer, went from $500 million to $700+ million, right? Because, like I said, streaming is a terrible business. It costs a fortune in order for you to maintain because you constantly have to put content on it, which is telling you the more subscribers that they're adding, the more money they're losing. And that's the vision that they're bragging about. Everything else is getting crushed. But hey, we're in a different market, right? You got to look at it and say, if the Fed's going to come in and spend $6.5 trillion, which is 30% of our GDP, to keep the economy afloat, there's more trillions coming, right? But the yield curve control, in effect, is going to fix the price of bonds. In doing so, it fixes their interest rates. So they did this again in 1942 to help the Treasury fund cheap debt, and that was in World War II. But now YCC is going to ensure big companies, big corporations continue to get cheap money in the foreseeable future. I don't know if you saw the latest bonds that were raised, issued by Google. I mean, what was the interest rate on it? 0.45% or something? I forgot what. It was just, with Microsoft. I mean, these guys are borrowing money 40 years out for nothing, right? Our mortgage rates are 3%. I mean, you talk to someone in the 80s that bought a house, they'd be like, oh, are you crazy? 3%? No way. So that yield curve control, it's inevitable. This is a tool that they're going to announce. And I'm not the only one that think this. I mean, for me, there's two people that you want to follow when it comes to the bond market. Right now, to me, right? There's a lot of them. You have your own name. Jeffrey Gundlach is one of them. June 10th. Again, if you're not familiar with Gundlach, he's a billionaire fund manager, probably considered Warren Buffett of the bond industry. He goes, I certainly do expect, I'm quoting him here, that Jay Powell would follow through on controlling the yield curve should the 30-year rate really get unhinged, which it is. Scott Minerd, if you haven't heard of him, managing partner, chairman, global CEO of Guggenheim Partners. They manage over $270 billion. One of the most respected people in the bond world. On June 8th, he said yield curve control could prove an interesting tool to limit money supply growth while keeping interest rates low in the event of a sudden surge of inflation, right? And what do we worry about here? What we're hearing, everyone's popping up, right? Something that I said in March when the Fed started going crazy. We're going to see inflation beyond belief once this COVID thing dies down. So here's Scott Minerd. Guy that's much, much smarter than me, much smarter than most people out there, especially when it comes to bonds. Hey, yield curve control, keeping interest rates low in the event of a sudden surge of inflation. So yes, big corporations are going to benefit. But if you're looking at what they're doing here, it's really going to inflate the high risk assets. And if you're looking at small cap stocks, they've underperformed the market so far. In fact, if you're looking at the top 5 stocks, which account for 22% of the entire S&P 500, they accounted for over 55% of the gains over the past 12 months, while the rest of the market accounted for 0.6% of the gains. So if you don't own any of the major technology stocks, it's not FANG, take out the N for Netflix and throw in Microsoft, right? And get those 5 stocks. If you don't own them, chances are you're flat. If you're beating the market, it's good for you. But most people aren't. That's why I'm sure a lot of you sitting home go, the market's hitting new highs. I'm hearing Tesla going here, all these companies going crazy. It's really 5 companies. I mean, Tesla's getting up there too, right? It's pretty crazy. And Netflix and a lot of technology companies, but most companies are still underperforming, which is, just the facts. But the Fed, I believe, is going to announce this before September. If they do, you want to position yourself in small caps. Now, I say this all the time to you, every single time. Whenever we promote our products, I try to promote my products at the right time. Because the last thing I want to do is promote a crypto product when crypto prices and Bitcoin's at 19,000, right? Because it's an easy sell. Everyone's going to get in. It's a story and you get destroyed. I've been doing this for 25 years. No one's really talking about small caps right now. We have, I personally think, yes, I'm biased, the best small cap newsletter on the planet, right? Something I've been doing for 25 years. That's what I launched this business on, which is Curzio Venture Opportunities. We sell it for a lot of money. I'm discounting it by 60%. I'm going to do that for the next couple of weeks. Anyone that's listening to this, I'm going to send that out to you. And if you want to subscribe. It's up to you. Again, it's not a sales pitch or anything. For me, I want to get you involved in the right industries at the right time. Because when you do, you're going to make a shitload of money. And of course, you're going to buy more of our products. But that's my goal here. That's why I do this podcast. I want to try to help people out there. I want to try to give you guys the real story. That was the name of my original podcast when I took it over to Street from Kramer and Aaron. It was really cool. I haven't spoken to Aaron in a while. But anyway, when I look at small caps and the Fed initiates this policy, and again, it's probably going to happen. So the best bond managers say it's going to happen. You're going to see a lot of these assets really go. We haven't really seen that move in small caps. Small caps involved in technology, yes, of course, because of COVID. But you're looking at the COVID problem that these politicians are going to extend out through the election. So you're looking at 7 more, November's election, but you're looking through Q1. We're not going to get a vaccine before Q1. If it is, no one's going to take it. But you look at through Q1, 7, 8 months. To put that in perspective, how bad has COVID been and to change the world? It's only been 6 months, right? So this COVID thing is going to be pushed out where economy is just going to say, we're going to close or whatever. And it's going to force the Fed to do this, yield curve control. And when they do, risky assets are really going to take off. And you're going to see risky assets even in not just in secular sectors, right? What we're seeing, what we have in technology, but cyclical as well, the ones that have underperformed. And if you nail some of these things, the risk reward, I said a couple weeks ago, the risk reward for small caps has never been as great as it is now. You might say, Frank, that's insane. Look at, Wayfair went from, what is it, in 20s to 200. You're looking at how many stocks have you seen? The Zooms. These are small cap stocks that you're looking at so many of these names that are under $1 billion valuation that have taken off to $5, $10, $15 billion valuations. You don't really have markets that you could do that. Now, could it reverse? Could everything fall apart? Could the Fed say we're not going to bail out anybody? Of course. That's why you want to put stop losses in. But right now, with that newsletter risking 35%, you're able to generate 2, 3, 4x returns, which is a fantastic risk reward. Is it risky? It is risky, but the reward is worth it considering with some of these stocks that even you look at Teladoc Health and just the virtual health companies, in the right sectors, these companies were very, very small. You're going to see a huge boom in small caps. And if I'm wrong, all right, you're going to risk a little bit and you'll lose a little bit, but still you want to limit your losses on this. But if I'm right now, the chance to buy so many of these names that are down tremendously, that have not outperformed or kept up with those technology stocks, it's one of the best times I've seen to buy small caps, again, based on risk reward. So I'm going to be sending you guys that offer. We did a great promotion. I'm going to do video promotion on it. If you guys are interested, it's fine. It's Curzio Venture Opportunities. That's our flagship newsletter. That's the one I launched Curzio Research on. So it's something I'm very proud of, something I've been doing all my life. But you don't hear me talk about it often. You don't hear me mention that often. You don't hear me offer discounts often on that product. I'm going to do that over the next couple of weeks for you guys because I really want to see you guys get in and benefit from this because this is where I'm putting my money as well.